us know what he's seen for 2024. So Ted, take it away.
Sure. So first things first, from a compliance standpoint, I've got to put up the disclosure that says that despite what I might have gotten right this year, I've got to give the disclosure that everything I might say could very well be wrong. So the main question that we're trying to answer is, what do we think? Are we going to see an economic recession in 2024? Reuters is disclosing that both Japan and the United Kingdom entered into a recession in 2023. What I want to do is I want to take a look at the stock market. This is the Nikkei average, and I want to talk about whether or not this declaration that Japan was in a recession, is it even helpful? I would argue no. If we add that gray bar that I've now added to the screen over here, that's the period of recession that is being reported. The third quarter for Japan, their GDP shrunk by 3.3%, and the fourth quarter was down 0.4%. My question is simply, and maybe this would have been a better polling question, is this the fact that we're declaring that Japan had a recession last year, is that helpful? Well, I'm going to argue no, because look at the Japanese stock market now. Well, if we also zoom out a little bit, we can really see that Japanese stock market is at levels that they haven't seen since December of 1989. And the main point here is, first of all, number one, yes, it did take the Japanese Nikkei index that long to recover the highs from 1989. And so the fact that we're seeing a recession, or they're declaring a recession for 2023, is that helpful? Well, I'm going to argue no, because the Japanese stock market is actually very attractive right now as it came out of this period right here. So the disclosure here is that while we're naturally curious about whether or not we're going to see a recession, to some extent, or the declaration that we're in a recession, it's always historical. It's always, hey, by the way, last year you were in a recession. Well, great, now I'm in this year. What's happening this year? So that said, let's look at gross domestic product for the United States. Now, what I failed to mention is the British economy last year. I think the UK's economy shrunk 0.3 and then 0.1, something very, very small in the third and fourth quarter, but that was enough for that to be declared a recession. Well, in 2022, the first and second quarter of 2022, our economy, as measured by GDP, also shrank, but it shrank very, very small, a very, very minor contraction. And I said, and I continue to say, that was the recession. Historically speaking, a textbook definition of a recession is 2 consecutive quarters of negative GDP. Well, daggone it, there's 2 consecutive quarters of negative GDP, and especially now, because when these reports are issued, they're always revised after the fact. If you know anybody in accounting, is there any accountants on the line? If you know anybody in accounting, that quarter end is always a little bit hectic. And especially if you're a publicly traded company, you report your quarterly results, and then, shoot, we got through that. Well, then the next week you start going back and verifying that you did all your math correctly. Well, the government does the same thing. Well, we've had plenty of time. All of those numbers have been revised, and I would argue they're final, but we're still not having that declared as a recession. So the National Bureau of Economic Research, they are the fine folks who declare whether or not we had a recession, and they are still saying that that was not a recession. Well, why is the UK having a negative 0.3 and a negative 0.1? Why is that a recession? But our numbers from 2022 was not a recession. I don't know that answer. The other thing that we're going to talk a little bit about is how this is actually calculated. We'll come back to that in a minute. Now, I mentioned my YouTube, the YouTube channel for my firm. And if you happen to watch that, the first month, January, monthly market monologue is what I call it. And one of the things I talked about in that video is the fact that the federal funds rate is actually a risk to the stock market in 2024, because for whatever reason, I'm still perplexed by this, but a lot of the stock market participants have been, they've priced in a lot of rate cuts and fairly aggressive rate cuts. And I never thought that was realistic. And so one of the things that I said in that January video was that when people finally start to realize that it is very unlikely that the Federal Reserve is going to cut rates that many times or that aggressively, the stock market is most likely going to react negatively. Well, I think it was the last couple of weeks of January, the stock market was a little sketchy, and that was because stock market participants were digesting some of what Chairman Chairman Powell was talking about, and the fact that they're starting to help people to understand that we're probably not going to be cutting rates that aggressively. So that green line that I've drawn on this, you can see I've got it at 4.25. And that's what I'm going to suggest is a reasonable target for the federal funds rate. On the screen right now is what I would argue is a decent proxy for the federal funds rate. This is the yield on a 10-year Treasury 10-year Treasury bond. And you can see on the far right corner, the current rate is about 4.27%. Why do I say that is a reasonable proxy? If we overlay the federal funds rate with the 10-year Treasury yield, you can see a high degree of correlation between the two. So this is why a lot of people, myself included, would argue that we might not really need the Federal Reserve to actually set the interest rates. We could just use the 10-year Treasury yield as a proxy. So why am I saying 4.25 is a reasonable target? Well, that's why I'm saying 4.25 is a reasonable target for the Fed funds rate, because the 10-year Treasury is basically at 4.25. This is not me being trying to be a great prognosticator. I'm just looking at the market to see what's the market suggesting. All right, so this is the yield curve. We talked about this the last couple of years. I've done this. So what is a yield curve? For those of you that don't know, this is the 10-year yield. So what is the yield on a 10-year Treasury? 4.27. And what is the yield on a 3-month Treasury? Well, I don't know that figure off the top of my head, but the reality is you plot this by taking the 10-year yield minus the 3-month yield, and you chart it out, plot it out. That's what you see on the screen. Now, I'm going to show you in a second the 10-year minus the 3-year yield. But I like to use the 10-year minus the 3-month yield simply because the gentleman who wrote his dissertation on this, his name is Dr. Campbell Harvey. He actually teaches over at Duke University. And he's arguably the one that discovered this yield curve inversion and the predictability of the predictive power of this. And in his research, he uses the 10-year minus the 3 months. So I figure he came up with it. I should defer to him and use what he uses. But what I want to highlight is the fact that every time this yield curve goes below the zero line, the black line is a zero line. Every time this happens, shortly thereafter, we get a recession. The recessions are these gray bars, okay? Right now, we can say that the 10-year, and I'm going to zoom in. This is the zooming in. This is still the 10-year minus the 3-month. So far, every time this yield curve has inverted, we have gotten a recession. However, the challenge is in the lag times. You can see right here in the middle, when this yield curve first went inverted to the recession was 30 months. That's 2.5 years. And then there's another one over here where it's almost 2 years. So yes, every time this yield curve has inverted, we have eventually gotten a recession, but you can't use this as a timing device. And so right now we've been inverted for about 15 months. So is this forecasting a recession? Yes, this yield curve is indeed forecasting a recession. It is still possible that we will avoid a recession, and this yield curve will, well, what is it? It's uninverting. What's the opposite of inversion? Uninverting? Well, actually, when we look at the 10-year minus the 3-year, we actually do see that right here on the far right, it did uninvert, but then it has reinverted. So this yield curve is indeed forecasting a recession, but one of my contentions is it doesn't mean it's going to guarantee that a recession is going to come. And if so, we also don't know when it's going to come. So we're going to come back to that in just a second, because we're going to, just like last year, last 2 years, I think I did it like a little bit of a scoreboard. And so we're going to do the same thing. We're just going to do the weight of the evidence. This is recessionary. This is not recessionary. So far, that one is recessionary. Keep that in mind. This is inflation. Obviously, inflation has been the big problem this last couple of years. I'm showing here a long-term chart just so you can see how bad it was over history. The red line represents a 10-year average. And so you can see where I'm highlighting the fact that Chairman Volcker got appointed. He very aggressively raised rates and inflation came down. Well, where are we at right now? You could easily argue that Chairman Powell and the Federal Reserve has done a reasonably good job of bringing inflation back under control. They got a lot of flack, from myself included, that they kept saying inflation was transitory. Inflation was transitory. Well, I guess we would have to define, what do we mean by transitory? Because for most of us, the duration of this high inflation wasn't transitory. But in the grand scheme of things, 1 year of bad inflation is arguably transitory. But for right now, inflation has definitely come down. You can see we're almost back to that 10-year average. Yes, the 10-year average has naturally risen, but 2.8 is manageable. Inflation is defined as too many dollars chasing too few goods. And if for those of you who took an econ class, this is your classic economics chart where it's supply and demand. And as the supply has gone up, the demand has stayed constant, we're going to have a problem. And so one of the things that we want to look at is we want to look at the money supply. And this is the amount of money that is available in the economy. And this is another polling question that I could have done. Have you ladies ever heard about people talking about returning to the gold standard? You know what I'm talking about? Have you ever heard that? So some economists, some political pundits talk about the fact that we have a fiat currency. That is true. It's a paper currency. And we should return to the gold standard. Well, why do people think we should return to the gold standard? Well, the reason people would advocate for returning to something like the gold standard, and I'm not advocating, I don't think you can put that toothpaste back in that tube, but the reality is you're going to be able to control, inflation would be very much controlled if you were on a gold standard, because they can't print more gold. Despite what the alchemists want, you cannot print more gold. They do discover more gold, but the rate of discovery of gold is pretty close to about 2% a year, which is arguably what Chairman Powell talks about in terms of his preferred rate of inflation. Their target rate of inflation is 2%. Well, there are some that would argue you can get that if you return to the gold standard, because they're not printing more gold, but they are printing more money. And you can see over on the right where we printed an awful lot of money during COVID. Well, the good news is the money supply has come down. Bad news is it has ticked back up. And I'm going to argue that that is a dangerous sign that we might see inflation begin to tick back up, if for no other reason, because the money supply is beginning to tick back up. So that is one of our risks. That's just the rate of change at the bottom. We won't bore you with that. This is the federal debt. And, let me pound the table for a minute. This might be asked in a future polling question. I would argue this is one of the biggest risks to our economy. I'm going to show you why. So this is a total amount of our federal debt. But what I like to highlight whenever we talk about this is to point out that the bottom of this chart is not the zero line. The bottom of the chart is still 30%. And so I assume most people on the call remember President Reagan when he was in office. And one of the things that he got credit for is winning the Cold War. Well, how did he win the Cold War? Well, this is an oversimplification, but we had massive increase in defense spending. And so traditionally speaking, we as a nation, we borrow money to fight a crisis of some variety, but then traditionally we pay that down, we pay it off. Well, arguably since 1980, the debt has been increasing. We did see a little bit of a rollover here in the 90s. This is arguably as a result of the dot-com bubble, if you will, and all the capital gains and the capital gains rate at the time. All of that helped bring some of the debt down, but we didn't come anywhere close to restoring it back to where it was prior to Reagan taking office. And where we're at right now is on the right-hand side. Again, this is total federal debt as a percentage of GDP. So we now have more debt, 120% of our national economy. And this is the problem. The blue line is our defense spending. The green line is the interest payments on our debt. So our interest payments on our debt are now equivalent to our defense spending. And as I was preparing for this, I saw this article pop up on Reuters. Apparently, President Biden is slashing the F-35 jet order about 18% in his budget request. The same day that that report came out, another report in Reuters says a U.S. Congressional Intelligence Chair warns of serious national security threat. Well, I would argue that's the problem. If we're spending so much money on paying down our debt, do we have the money to do national defense? Or if you want to debate about whether or not we should be helping Ukraine or Israel or any other nation in the world, I don't care. Well, at some point, we're not going to be able to afford to. So again, another polling question that I could have done. What is this? This is the surplus or deficit. And I'm going to add a zero line to this chart. There's your zero line. That black line is the zero line. So anything below that line is a deficit. Anything above that line, and there's not a lot above the line, anything above the line is a surplus. And again, you can see that we actually had a surplus in the late 1990s when Greenspan was chairman. Apparently, they were actually discussing what do we do if we actually pay off the national debt. That was a conversation at the Federal Reserve Board of Governors. Crystal, they didn't have to debate that for very long. So this is a problem. And again, just recently, this is American Enterprise Institute. And what I want to highlight is what they're saying. The headline is that the U.S. is on track to run annual deficits in excess of 5% of GDP. Apparently once considered an unthinkable threshold to cross even for a year or two, they're now suggesting that we're going to have 5% deficits in perpetuity. Now, part of the message that I'm going to try to get across to everybody today is be careful what you read. So don't put too much credence in this, but this is definitely a problem. Now, I'm going to go back and I'm going to explain this. I talk about this chart a lot, and this is what I want to explain between a secular bear and cyclical bulls. This is 1965. This is the S&P 500. So it's the top 500 stocks in the U.S. as measured by Standard & Poor's. It is 1965 through 1979. And you can see that there is an upward bias. The far right of the chart is indeed higher than the far left of the chart. So yes, you made money if you were in the market during that time, but you did it very, very violently. And what I want to point out is this secular bear and cyclical bulls. This was happening when we had these types of deficits, right? 65, this is 1960 through the 70s up here. So there's not a lot of deficit spending. There's some, but now look where we're at. All the way over here, we have massive deficit. That is a very big problem, and I think it is a very big risk. So we'll come back to the whole secular bear market in a minute. Again, this is one of my favorite charts. This is what I'm trying to get across here is there's always an argument. Do we increase taxes? Do we cut spending? Well, I'm going to argue that it needs to be both, because there's a lot of information on this chart, but the green line represents the highest income tax bracket. And the data goes back to the 1930s, okay? The black line represents federal receipts as a percentage of GDP, and the red line represents a 12-year average. So in order for that red line to mean anything, you got to have at least a solid 12 years of numbers before you can get a decent 12-year average. But what I want to highlight is, well, Michaela, let me ask you. Well, just since I can't ask everybody, I can ask just Michaela. Michaela, what was the highest tax rate in history? So we know it's north of 90, 95%. I know that's what you're about to say, but for sake of time, I'm just going to help you out. So that's the highest income tax rate in history. Now, where are we at right now? We're very low at 37%, very low as it relates to where we have been. And so all I'm simply trying to, and this is an oversimplistic argument, I get that, But all I'm trying to say is that what's the average? On average, we get about 16%. The federal government brings in about 16% of GDP in terms of tax revenue, regardless of the tax rate. Does that make sense? Did I explain that well enough, Michaela? Regardless of what the economy is doing, the government is going to collect about 16%. Regardless of what the tax rates are, it tends to be about 16%. So the argument is you can't just raise taxes and fix the problem because it's not going to do anything. You're still going to get 16% of GDP. Anyway, let's start burning through some of these scoreboards. So we already talked about the yield curve, and we said the yield curve is recessionary. So let's start looking at some other items. This is durable goods. I would argue this is not recessionary. That's growing. Yes, it contracted a little bit, but it's back up pushing highs. I would argue that is not recessionary. Building permits. Let's talk about this for just a second. Building permits and housing. There's several different ways to look at this. There's obviously a correction over here. And this is where we really started to raise rates and where we had really high inflation. Two suites down is the attorney for Pulte Homes. And I was chatting with him about a year ago. It was about January. And he had told me that they had laid off a bunch of people. And then in January, they ended up hiring them right back. And I made a comment to him. He said, yeah, I really think it was a bunch of millennials that went home for Christmas complaining about not being able to buy a house because mortgages were at 6% and their parents slapped them and said, are you kidding me? My first mortgage is at 12%. Go out and buy yourself a house, because home building stocks were one of the best performing sectors last year. And so what you're seeing right now is it has contracted. We've come back up off of those lows. And what I want to highlight is there's a little bit of a shelf right there where that red line is. That's a level that I'm particularly watching, because building permits arguably is a very big warning sign. If we really see a drawdown in terms of construction loans and building loans and things of this nature, that is a big warning sign. So it'll be very interesting to see the next several updates and then what this trend is, especially as we go into the spring portion of the calendar where we would historically get more building construction projects started. For now, I'm saying that is not recessionary. Value of new orders, manufacturing orders, guys, that's at all-time highs. That's pushing all-time highs. That is not recessionary. And so also not recessionary. The stock market. Let's pause on this for a second. We talked earlier about the Japanese economy and how the fact that we are now coming out and saying, hey, by the way, the Japanese economy was in a recession, I would argue is 100% irrelevant, because the Japanese stock market is at all-time highs and is very, very attractive right now. We said also that the yield curve does have a 100% batting average. So yes, it is a very good indicator of whether or not a recession is coming. I would argue a very strong indicator about recessions is also the stock market. The stock market is discounting what's happening into the future. Okay. And if the stock market is moving higher, I'm telling you, that's the average investor is not thinking that there's going to be a recession. So we're pushing all-time highs again. I would say the stock market is not suggesting that we're going to have a recession. Now, full disclosure, the stock market does have a history of forecasting recessions that never happened. And by that, I mean, whenever we see a pullback in the stock market, and you could argue right over here where we're coming off of these lows in April and we're coming back down, you could argue this is a recession that the stock market forecasted that didn't actually happen. Well, when the stock market expands like this, a natural contraction, a natural pause in activity is very, very common. And I know I was joking about inflation and Thanksgiving, but Thanksgiving is one of the examples that I use in terms of talking about the stock market digesting. When you see a massive run up in the stock market, it's almost like the analogy is when you overeat. Speaking for myself, at Thanksgiving, I overeat. Well, what happens after Thanksgiving? Well, at my house, a whole lot of nothing. I mean, there's just a bunch of slothfulness. We're not doing anything because I'm trying to digest that massive meal that I just had. Well, the stock market does the same thing. The stock market will have a run up, and then, well, we're going to pause for a little bit. And you see that often, but right now there is no pause. Now, today the market is down a little bit, but one day doesn't make a trend. So for now, I'm going to say the stock market is also not suggesting that there's a recession. This is consumer sentiment. You're probably familiar with the University of Michigan Consumer Confidence Survey. That's what's on the screen right now. Full disclosure, there is a lag in this data. But when you look at the right-hand side of the chart, we're coming off of these lows. Now, is it as high as it was just a few months ago? No. But again, this is well, I'll use me as an example. I try to get up in the morning before coming into work. I try to go exercise. How am I feeling? I'm feeling like I don't want to exercise. It's 5 o'clock in the morning. I don't want to exercise, but I know if I don't do it, I'm going to regret it later. So despite how I'm feeling, I go exercise. So the consumer sentiment is, how confident are you, Mr. Consumer? I'm not very confident. Where are you going? I'm going to buy a new car. So the consumer sentiment survey it's an indicator. It's not a great indicator, but it is very popular. And it's one that a lot of people on this webinar have probably looked at. So that's why I include it. The other thing that I point out is this black line. Look at the black line at the bottom. It goes all the way back to 1980. So in 2022, the consumer sentiment was the lowest it has ever been. Well, it's come off of that. But this also goes back to the question that you asked, Crystal, in terms of prices. So is inflation high? It is higher. It's not high, and it's not getting worse. It's getting better. But tell that to anybody that's going to the grocery store, right? And so how do you feel? Well, I don't feel very confident. Why? Because do you have any idea how much I spent on that can of beans? That type of thing. So that factors into this, but what this doesn't necessarily tell us is what are they actually doing? We'll talk about that too. So again, this is not recessionary. This is from the Chicago Federal Reserve. And this is the credit sub-index. It's measuring credit risk. And again, I should probably make those gray bars a little bit darker. Sorry if you can't see them, but you can see these gray bars. And what happens is the credit sub-index rises above the zero line as we're going into recession. And every time on the screen, it did that. Every single time before recession, it rises above the zero line. Well, where are we at now? We're below the zero line. So this is also not suggesting a recession. Unemployment. And there's several examples of this where we have to be very careful about what you read in the news. And somebody sent me an article not too long ago from WRAL's TechWire, their website about the technology sector and jobs and things of that nature. And hey, so-and-so is laying off. Okay, well, what is that doing to unemployment? Right now, unemployment is really very low. And again, what I've done, that black line at the bottom, I'm trying to show you it's at the bottom of like a 20, 30, 40 year range. I guess that's 30 years. It's at the bottom of a 30-year range. That's not recessionary. And this is initial claims for unemployment. Again, not recessionary. Yeah, again, there's your zero line. Unemployment rate. Okay. Several years ago, this was in 2022, the fine folks, the geniuses at the International Monetary Fund put out a research paper that suggested, remember 2022, inflation is at 40-year highs. International Monetary Fund researchers got together and they said, you know what, in order for inflation to be under control, the US unemployment rate is going to have to reach 7.5%. That's what they said. Well, where are we at now? We're at 3.7. Where's inflation? Back within striking distance of 10-year highs. Now, I do think inflation, we are at a risk of inflation ticking back higher. I do think that's true, but we are nowhere near 7.5% unemployment. So again, that's my caution. Be careful what you read, because most of the people that are writing articles have journalism degrees, not economics degrees. North Carolina unemployment, most of us are probably in North Carolina. That rate is also very low. So unemployment, not recessionary. Let's talk about job openings, though. This one does concern me a little bit. the job openings have come down quite significantly, but I'm also going to have to point out how high it was. It was never as high as it was in 2022. So I'm not convinced this is recessionary. I think I'm going to end up putting this down as inconclusive. This does concern me a little bit. This as well. The blue line is measuring temporary help, and the green line is total non-farm payroll. Usually these two measures kind of move together. There's a divergence here, and that is a little concerning. But right now, I'm lining that up with this chart and saying, well, job openings is coming down, and what I think is happening is employers are taking down temporary jobs and they're giving them full-time jobs. So non-farm payroll is up, but temp jobs are down because, hey, we need the help. I think that's what's happening. But Crystal, Reagan, and Michaela, you guys have obviously some insight in this. What's your interpretation of this?
Yeah, I think that's interesting. I probably more so, clients always play a little bit of the shell game when, money gets tight, or if they go on a hiring freeze, they might shift from, okay, our full-time permanent positions are now on hold, but however, the work still has to be done. So they'll bring in contractors. Now that's more like staff augmentation. We also do, specialize like ERP implementations and due diligence work. So it wouldn't be in that category, but let's just say your typical staff aug, I need an extra set of hands on deck because the work has to get done. So in that way, I do think there is some swapping that happens. I would have to sit down and look at this a little closer. I can tell you us personally, fourth quarter was feeling a little soft, but starting kind of mid-January, kind of typical business cycle, we saw things pick up fairly significantly, and at the higher levels, right? Everybody's hiring in the middle of the org chart because the elusive 5 to 7 year per accountant that everybody wants to hire. But at the top end, we did see that uptick happen again in mid-January. So all that to say, I think what's happening is some companies are probably just identifying which positions they absolutely can now maybe do without, and maybe they're scaling some of those back, or they're doubling down and just waiting for a little bit of the layup that hit the market and maybe help push some of those salaries down. It's kind of like inflation. It's really hard to push salaries down. That's going to take a lot of pain in the marketplace before that actually happens. But I think some companies are hopeful for that.
No, interesting. Well, sorry, I put you on the spot. So layoffs, again, same thing. If you occasionally see something in the news media about such and such a big company here in RTP is laying off, we have to look at it through the lens of the macro data. This is not concerning to me. So job openings, I guess I did end up calling that not yet recessionary. If you want to move that over into the inconclusive line, I'm still going to say the weight of the evidence is still not recessionary. Dr. Copper, I won't spend a ton of time on this. There's a debate in my industry. Does copper really forecast recessions very well? It's cliche. I would argue where the price of copper is right now, I'm not saying it's recessionary. It's not expansionary because we haven't taken out the recent highs. So I ended up putting this one down in the category of inconclusive. So if you want to do job openings in the inconclusive category, fine. You got 2 over there. Keep that in mind. We're going to pick up the pace. Household obligations. This is basically the amount of debt payments that people have, including their mortgages. This is rising, but it's not yet a concern to me. One of the things that I'm curious, I haven't figured out a way to do this, but I'm curious to see this broken down generationally, because we have most of our clients are 50 and older, high net worth clients that they've paid off their mortgage. They don't have a mortgage. Well, that factors into their household obligation ratio. So this does not concern me just yet. Again, look at the rates of where we're at today versus where we were before the COVID recession, before the global financial. We are still very, very low. But again, I'm very curious to see how this is impacted by the generations of folks out there that they've paid off their mortgage. This is credit card debt as a percentage of disposable income. Again, a warning, when you're reading the newspaper, I've seen several reports where credit card debt is at all-time highs. Yeah, in terms of dollars, sure. But what is it in terms of disposable income? It's not that bad. Is it higher than it was? Yes, that's expected. It's not that bad. The next one, however, this is a little bit more concerning. This is credit card delinquency rate, and we're at 3% delinquency. Again, is that bad? It's not good. And it's higher than it was prior to going into COVID. And I've seen some people say that this is coinciding with some of the student loan forgiveness. I don't know. I'd have to really parse into that data. This one does concern me a little bit, but I'm not thinking that's going to derail much. This is one where we should park a little bit. This is business loans. We talked a little bit about GDP. GDP is calculated by consumer spending plus investment spending plus government spending plus net exports. That's how you do the GDP calculation. And you guys, you might have heard people say that the American consumer represents 70% of the economy. Well, that's a half truth. The American consumer represents 70% of the GDP calculation, but the GDP calculation is a bad calculation. The problem is we've been using that calculation since the 40s, plus it has widely been adopted all over the world. So everybody uses a bad calculation, so nobody's going to start using a new one. The problem with GDP is it is calculating final goods. So I was talking to somebody earlier today, and they're on their way to go to Greensboro and get a new car. That car is calculated in GDP, but the steel that is in the car is not. So when I think they're going to get a Kia. When Kia bought leather for the seats, that's not calculated in GDP. When Kia bought steel for the frame, that's not in GDP. It is only the final good of that car. That's what's in GDP. Well, I would argue that the American consumer does not drive the economy. It does obviously drive GDP, but it doesn't really drive the economy, because where is the American consumer getting their cash? COVID years notwithstanding. Well, they're getting it from their employers. So how healthy is the business environment? Well, this is business loans. Business loans, you can see, has kind of leveled off. It corrected down. It's risen back up. It's kind of pausing here. I would argue this is not yet recessionary. Again, it'll be interesting to see what happens with the next update or two. Does it break through that floor and fall? That would be a concern. Or does it spike back up? I would argue it's probably more likely to spike back up because of what's likely to happen with interest rates. Interest rates are coming down. I don't think we're going back to zero anytime soon. But if you're thinking about getting a large loan to build a new manufacturing plant, you know what, why don't we wait until later in 2024 when the rates are likely to be a little bit lower? We talked briefly about this secular bear market. This is a 15-year time period. And a way for us to look at the overall economy is just by looking at the stock market. The stock market was very, very violent through this time period. That's a 15-year time period. I would classify that as a secular bear. But even within secular bear markets, you can have cyclical bulls. And so what I'm trying to highlight here is these time periods with the green arrows, those represent cyclical bull markets. And the point of me trying to say this is right now the stock market is at all-time highs. I still think it is possible. I'm not staking my career on this. I still think it is possible that we are in a secular bear market that is simply experiencing a cyclical bull. Okay. In other words, one of the concerns that I have, obviously, based upon that last question, is the amount of debt that we have. Now, if we could go complete conspiracy theory, if you want, and talk about one of the ways to solve the debt problem is by inflating the dollar. If we inflate the dollar, then it's a lot easier to pay off the debt. Let's not go there for now. We are going to run out of time. But I have a lot of concerns about whether or not we are in a secular bear market that is simply experiencing a period of cyclical bull. So yes, the stock market is healthy right now. Do I think it's going to be that way for the next several years? I have no idea. I'm not issuing any types of prediction, especially for me and my firm in terms of what we do. We manage money actively. And just to help you to understand, why do I look at this stuff? I look at economics because I'm looking at a macro level. I'm starting with a big picture. And what's the big picture framework of what type of environment that we're in? For example, I wrote a white paper several months ago, and the title of the white paper is Measure Risks, Invest Accordingly. So if we're measuring the risk first, what's the risk of the macro environment? And then we can make decisions in terms of portfolio management. The reason I don't make any of these predictions is because we make changes. We're active fund managers. We're managing the portfolios and the positions and the ETFs and the stocks. We're managing that stuff actively. If we put a stock on and it goes against us, we're comfortable taking it right back off. So we don't have to make long-term forecasts, but I make this a habit of mine to look at the economics simply because it's helping me to shape my macro view so I can help me determine what is the risks of the overall environment. So that is a secular bear market with these periods of cyclical bulls. And then, by the way, when you adjust that 15-year time period, I've now added 2 more years. You adjust for inflation, we have a really difficult time in that 17-year time period. That's one of my big concerns. Now, for the last couple of minutes, I thought you guys may not know about this, that there's an election this year. So joking aside, you may not be familiar with predictit.org. You can go there now on your computer if you like and get updated data, but I'm going to show you a couple of things from Friday. And I'm not adding any political commentary here. I'm just telling you, this is kind of like a futures market. So in the morning, I exercise, I then try to get in my Bible. And then after that, before I go hit the showers, I'm taking a look at the futures market. What's happening in the stock market and the futures market? Oh, the futures are down today. Well, you know what? It might be a tough day today at the office. This is a way, predictit.org is a way to kind of look at the futures market in terms of some of the bigger political questions. You're not going to find your county commissioner listed on this site, but in terms of the president, it is indeed in here. So basically what's happening, this is people that are making bets. They're making bets on who do they think in this case, I've got on the screen, the Republican presidential nomination. I find it funny that Mitt Romney and Mike Pompeo are still getting, have ever gotten any bids because they've never declared anything that they're going to run. Ron DeSantis, I understand why he might still get some. But anyway, that's what the people that are willing to put money behind their bet, that's what they think is going to happen. What about the Democratic nominee? Again, that's what people who are willing to put some money behind their bet, and you can see these are you're betting in cents. These are not big bets, but that's what these bettors are thinking is going to happen. Who's going to win the White House? And then what I find interesting, and we can wrap it up in just a second, is the blue line is Trump, the purple line is Biden, and then you got Newsom on there as well. And so you can see what's happened over the last, I think this is 90 days. Over the last 90 days, Trump has picked up some steam, Biden has lost some steam, and as Biden is losing steam, Newsom is gaining some. I find that interesting. I'm not making any predictions,